Good afternoon, everyone. Thank you for joining us today. We hope you are doing well and staying safe. My name is Maria Asher, and I'm part of the investments team that manages the Westwood Select Equity. Today, we wanted to take this opportunity to discuss distressed debt as an asset class, what kind of opportunities we are seeing there, when does it make sense to invest in this asset class, especially as we head into the post-COVID world. For that, we have Leah Bennett and Hussein Adatia joining us on the call as well. Leah is the president of Westwood Wealth Management Houston and is the lead PM on Select Equity Strategy. Hussein is a fixed income analyst and a portfolio manager on our credit opportunities strategy. With that, I'll hand it over to Leah. Hi, Leah. How are you?
I'm doing fine. Thank you so much, Maria, and welcome, Hussein.
Thank you for having me.
Thank you. And thank you guys all for who took the time to dial into this call. I think this is such an interesting topic and look forward to a really robust conversation. Credit opportunities was a strategy that we launched last year. I think the size of the firm is so fantastic for us because it allows us to be very innovative and also to be nimble when we see opportunities that we believe we can present to our clients. So credit opportunities was one of three strategies launched. And it obviously made sense when we launched it, which was March of last year, but also want to talk about why it is relevant now. And Hussein, I'd love for you to talk a little bit about the current state of the high yield and distressed debt markets.
Sure. And again, thank you for having me. We've certainly come a very long way from where we were in early 2020. Let's start with high yield first. In the high yield market, we've seen spreads compress materially. About a year ago, those spreads were about 1,000 basis points over treasuries, which was an extremely attractive time to invest in high yield. Today, those spreads are closer to about 300 basis points over treasuries. And so that 300 basis point level is about where we were in February of 2020, pre-COVID. So we've retraced pretty much all of the paper losses, if you will, from March of last year. And the high yield market is in a place right now where it's open for business. Pretty much any company that has cash flow has access to that market. 2020 was a record issuance year for the high yield market, and it looks like we're on pace to break that again this year in 2021. In high yield, in distress, it's a very similar story as well. About a year ago, the number of companies in the distressed index, if you will, totaled more than $1 trillion of bonds outstanding. Today, that number is materially below 100 billion. So we've seen a lot of companies survive through the pandemic, repair their balance sheets, and ultimately position themselves to thrive in a post-COVID world. Right now, optimism reigns supreme. However, even with a distressed debt index of about $50 billion right now, we are finding plenty of opportunities, and it works very well for a firm of our size. As Leah mentioned, we're able to be nimble, and we're able to really take advantage of some of the opportunities that we're seeing right now throughout the distressed debt world.
And COVID has been such an interesting period for so many reasons, but it has gone on long enough. I think you bring up a good point. It's caused some companies to become much more efficient than they would have been otherwise. It's caused companies to be more innovative, to rip out their expenses and address some cost issues in different ways, which obviously impacts the capital structure in general, both equities as well as fixed income. And while I know we're focusing on fixed income, you see this theme throughout us from an investment perspective. I would love, Hussein, can you talk a little bit about your process and kind of what you look for?
Sure. Right now, given where we are in the credit cycle, we're very focused on high quality companies. We want companies that have survived the pandemic, generally speaking, that that have adapted their business models and have proven that their management teams are resilient and can adapt to a rapidly changing environment right now. As far as balance sheets are concerned, we want companies that have modest, low to modest leverage. We want companies that have good liquidity, and ultimately, we want companies that have positioned themselves, to extract cost savings and to learn from the pandemic. It was a once in a century type event, but there are certainly lessons that can be applied. And a lot of their competitors are taking heed from those lessons. And these companies need to be able to compete, in a new world where productivity is going to be higher, where technology is really the driver of a lot of the efficiencies. And if you have a balance sheet that doesn't allow you to invest, it's very difficult to keep up. So, it all starts with the management team for us as well. Working with executives that have prudently managed the balance sheet, that are focused on paying down debt for our credit investments. That's something that is extremely important to us as we pick through some of the opportunities out there on the fixed income side right now.
That's fantastic. Yeah, and I think something else that's interesting is we've had so many fits and starts with this reopening process that volatility also creates some really interesting opportunities, again, both on the equity and the fixed income side. So I'm kind of curious where you are seeing opportunity today, and especially not just this as a snapshot, but maybe even versus what you were seeing, how that's evolved.
Sure. So, the ground zero for the pandemic has been a lot of the lodging, leisure, and entertainment type companies. These are the ones that were the hardest hit from the COVID lockdowns. So, we're looking at airlines, we're looking at cruise companies, theme parks, anything that involved the mass congregation of people. As we all know, was shut down pretty quickly last year. And a lot of those businesses are still, looking at another 2 to 3 years before they're able to really generate, normalized earnings, something similar to what they were earning in 2019. So, at this point, they've proven that they can survive. They've pulled many of the cost levers. A lot of them have benefited from some sort of government support, in particular the airlines. But even with the U.S. economy coming out of the malaise from 2020, there's still call it 2 to 3 years of cash burn that many of these companies need to address. And we believe that they're going to have to come to the market, come to the high yield market in order to help tide them over to get to a point where they are able to, once again, stand on their own 2 feet and thrive. So, airlines, cruises, hotels, those are ones that were in trouble at the beginning of 2020, and those are ones that are in, I call it less trouble right now. There's certainly a light at the end of the tunnel. Another area that we've been very active in is energy. As we know, conventional energy has been under pressure for a very long time. We have no illusions about where the world is heading in the next 10, 15 to 20 years. Clean energy is certainly going to be what drives our energy needs going forward. However, between now and then, there will be a very large place for oil and natural gas, to fulfill our energy needs, in particular outside of the U.S. The U.S. is moving very rapidly towards clean energy. Outside of the U.S., particularly in emerging markets, there's still going to be substantial demand for conventional fossil fuels, if you will. And one of the things that's changed from the beginning of the pandemic is a lot of the companies, in particular on the energy side, that were left for dead, have proven that as they go through a restructuring and they go through a bankruptcy process, they are able to shed legacy liabilities. They're able to really clean up their operations and get to a point where they're able to invest in their business and generate attractive returns for their investors. And it's been an area where we've been very successful in credit opportunities as well as other funds at Westwood. And it's an area that we still are finding new opportunities fairly often, given just the sheer volume of companies that need to restructure in the conventional energy space.
And I think that's probably such a critical point, is that there are so many that are out there now. Because I think sometimes when people think about this asset class, they think of it as being more opportunistic, and timing's really important. And a question that a lot of people might ask is, how do I know when I should invest in distressed debt?
Yeah, it's a very good question, and it's one that I fielded for the last 12 plus years I've been doing this. And what I've learned is very similar to the stock market. It's almost a fool's errand to try to time when to invest in this asset class. If you look back to the beginning of 2020, we had a very rosy outlook. Interest rates were moving higher, unemployment was at a record low. And within a matter of weeks, everything unraveled. We had global shutdowns. There were concerns about companies making interest payments. There were concerns about businesses paying their rent. And that ultimately proved to be the best time to invest in distressed debt. There's really no way for us to foresee that. And oftentimes the best time to invest is when it feels the worst, and that it certainly felt that way in the spring of last year. So that just goes to my point. It's very difficult to time when to invest. Why would I invest in a distressed type fund right now? For us, given our size, we're still finding plenty of opportunities to invest in, even though the sheer amount of distress has meaningfully shrunk at this point. For our fund, it's more than enough for us to comb through and opportunistically seek to invest in. I think it's very important right now to have a manager that understands where we are in the cycle. I have no illusions. It's not as attractive right now as it was, call it 1 year ago. But at the same time, we are able to, hopefully generate strong risk-adjusted returns and be in a position to really redeploy that capital into attractive opportunities when that time arises. And we've discussed this before. The way that we're positioned, we have a natural maturity schedule that allows us to really reinvest proceeds from existing investments into new opportunities without being a forced seller in a down market, which really drove a lot of the opportunities in March and April of last year.
And I think the point about size, I know we've mentioned this a few times, but it is so relevant. If you think about equities, the reason that you get outsized returns in small caps is because they're inefficient. And again, just you can apply the same principle over to fixed income. We're able to buy smaller pieces of debt, or we're buying a debt from smaller companies, but it's just a less efficient area. And so it's great we're able to take advantage there.
Yeah, just to put some numbers on it, a lot of the larger issuers in the high yield market, they generally issue in tranches of called 500 million and above. And if you're a larger investment fund, that's kind of the waters that you have to play in. For us, given our size, we're comfortable going down into companies that have $250 million issuers and smaller. And a lot of these companies are names that are just not as trafficked in. And it's not because these companies aren't profitable. Oftentimes they're more profitable, but it's just because the liquidity that those size companies offer isn't good enough for some of the larger companies, and that works to our benefit. And we've been able to opportunistically invest in those types of opportunities throughout the past year.
I think another thing that we should talk about, always when we're talking about Westwood investment strategies, we talk about risk management, but we also talk about, what is the next catalyst to trigger a change in the markets. And I'm kind of curious what you see as the trigger for the next distress cycle.
Yeah, if I had a crystal ball, that would make it a lot easier. But there are always factors out there that could potentially trigger the next downslide, if you will. Geopolitical risk has been there, for as long as investing has been around. Right now, everyone is talking about interest rate risk and potentially inflation. That's a risk that I think is real. We debate whether or not we think that it's a transitory spike in inflation, and even if we don't really necessarily believe that right now, it's still something that we need to position for because we don't want to be caught on the wrong side of that. Going back to 2008, 2009, what a lot of investors have done is they've really positioned themselves to understand and be prepared for the known risks that are out there. But I think it's the unknown risks, similar to the pandemic, that really create the biggest dislocations. And I hate to use the word opportunities arising from a pandemic because it seems kind of morbid, but that's just kind of how it plays out. It's those unknown risks that really that cause markets to sell off and overshoot to the downside. And we're positioning our portfolio to take advantage of those types of opportunities when they do arise. I don't know what's going to cause it. I think inflation may be part of the equation, but as we've learned over the last decade plus, it's usually things that we're not thinking about that end up doing the greatest harm.
Yeah. And if you think about it, the vast majority of downturns that we've gone through, as far as the economy or the market is concerned, it's usually led by credit. So credit is cyclical, and having some exposure certainly makes sense to that asset class.
Absolutely. And I think that, depending on what the Fed does over the next 1 to 2 years, if they do hint at potentially, raising interest rates, that will probably create another opportunity. I think, investors have become so conditioned to having the Fed backstop, whatever asset class they're buying, that when they do step away, it will create opportunities. And we saw that happen in 2011, 2013, and again in 2018, 2019. So there's certainly precedent for it, and it's just another one of the potential triggers that will allow us to hopefully opportunistically put more capital to work.
And I like, as you mentioned, those years, very frequent years.
Exactly.
Thank you so much, Hussein, and Maria as well. I think this has been an interesting conversation, just talking about how attractive the asset class is. And I think it becomes easy to just think about this as it was attractive last year, but those outsized returns are still there. And I think of this as being very consistent with the fits and starts that are going on globally. So again, you think about the US, we've done a great job of rolling out the vaccine. We have states now, some states have 70% of people vaccinated, which is great. But you've got Canada closing down again. You've got some areas in Europe that are really going through a distressed period, closing in, trying to get reopened for the summer, but really struggling with that. And that creates lots of opportunity within this asset class. So thank you guys so much for your participation. And thank you all so much for those of you all who took the time to dial in. We really appreciate you as clients and appreciate your support, and hope everybody has a fantastic day. Thank you so much.